All right, so let's get jumping today. So it is Friday, June 23rd, and right now the markets are down a bit. So SPX is down 25, NASDAQ down 135, and the Russell down 20. And what we're going to do today is just go through the portfolio itself. We're going to take a look at our tracker and our trading plan info, see where we are on some things. And then we're also going to discuss, as I had mentioned, we'll discuss, should we just go to 112s and forget about Strangles? And the answer is going to be probably not. But we'll get into the whys and wherefores of that. So I think the best thing to do is probably just jump into the platform itself that I'm showing, and we'll just review each trade. We're having a pretty good up day right now. So we're having a good update. The market's down, account is up. So that's all fantastic in here. All right, let's take a look. We've got two different trades on the Aussie dollar here as well. So let's look at the Australian dollar futures. We've got two trades working. Both of them are Strangles. One we've been in for 10 days, one for 17. The one for 17, we're already up 30% on that. The 10 days, we're down a tad, down 15% on that. If we take a look at what Aussie futures are doing as well, they're down pretty good yesterday and today. In fact, they're down for the week pretty nicely. I mean, they were up at about 0.69. They dropped to about 0.66. It's a pretty substantial drop in the Aussie dollar futures. Why have they dropped? Well, the DOXY, the US dollar, has risen. So the US dollar index has gone up for pretty much 3 straight days, and now the Aussie dollar has dropped for about the same amount of time. It's all good. Up, down, doesn't really matter right now. So it looks like there's some negative momentum on the Aussie dollar. Totally fine with us. We just got to stay in our range. Nothing to do on those two trades. But the one is getting close to 30%. So we're getting closer on that. We also have a euro trade is there. So we have the Euro FX futures. That trade is also a strangle that we've been in for 14 days. We are up almost 17% on that in 14 days. So right in line with hopefully hitting 50% in about 30 days or so. So we are on track on the Euro futures as well with a strangle. We're going to take a look at, we're going to go back to all 3 of these trades, or really 2 of them, and we'll take a look at what what if we put a 112 on? How does that make it different than the strangle? And is that something we want to do? If we take a look at oil futures, all of our CL trades, so we have 3 trades running on oil futures right now. So we've got a 112 trade that we've been in for 44 days. That's now up 164% on that trade. We are not in the trap, but we're doggone close to the trap. So if we take a look at that and we jump in on the Analyze tab on that, get a chance to see what that looks like. But here's that particular trade. Again, we are not in the trap, but we have moved down here, and you're starting to see the T+0 line, the little orangish line here. You're starting to see that bend a bit here as well. So bending up, which is giving us some extra profit. Let me see if I can pull up the info. So right now where we're sitting, we're up, what, 300 and some odd dollars on the trade, 575 on the trade right in here. So about 575. If they continue to drop, we're going to start to see closer to $600-700. And then obviously if we hit into the trap here, the max on this one is going to be pretty good, up there around $2,350 on that particular trade. So overall, it's good stuff, and we're doing well on that. And that is our 112 trade on oil. We have another 112 trade here on oil. I just want to make sure I switch to the right ones. It's the August 17th. So this one is a little higher up in the tail. If it expires, 420 bucks on that particular trade. On that one, just because this is going to come back and mean something more a little later. So this August 18th version here that we have, let's see, make sure. So August 17th. So this August 17th, we put this particular one on using about $5,000 in buying power. So right now we're sitting at 420. So it's a pretty nice, 8% return on margin. If we stand in here, that's going to be important to look at a little later on. But our trap on this one, 420 on about 5,000 in buying power. Now let's take a look at a strangle that we have on here in oil as well. So our strangle in oil sitting pretty nicely here. It's down a tad. It's down 300 or 300 some bucks right now, simply because oil has moved lower. But we're still sitting in a pretty decent spot. I'm not too worried about anything yet. We've got all the way to 54 on the downside, and we're sitting here down just a tad. But this particular trade has an upside. Well, we took in a credit on this trade for 73 cents times 2 contracts, times the multiplier of 1,000 on oil. So this gives us a $1,400 credit. We'll close at 50%. That's our goal. So we'll take in 700 on this trade for a roughly 5,300 in buying power. So if you remember, when we looked at the 112, I don't want to close that trade. When we looked at the 112, $420 on the 112 in oil, using about 5,000. So almost the same buying power, but about $100 or about $300 less on the trade when done. So the strangles do give us a much higher return on the margin that we use. If this strangle closes at a 50% winner on oil, so if this one closes for a 50% winner here on oil at $770 on roughly the same buying power that we were making, 440 on the 112. Now, you can argue that the 112 might be safer. The downside on this strangle is we're in trouble if we start to head down or getting assigned around the 54 mark on the strangle. And if we're on the 112, we don't get in trouble until we're close to 49. So a $3 difference or so further on the 112. So it is a safer trade. You can make more as we drop versus the strangle, but you're giving up a decent amount of income. On the 112, as I mentioned a little bit ago, the 112 in CL, I'm going to make about 8% on my margin. In the strangle, that $770 that we get is going to put us somewhere around a 14% return. So significant 50% more income from a strangle than from a 112, using essentially the exact same buying power involved in that trade. So just wanted to leave that one on for now so you can see what the differences are, but nothing to do, nothing to fear, nothing, big deal happening here. On oil, I expect oil to just keep meandering around in this area. It seems to have found a little bit of support around 67 and keeps bouncing off of that level. So I guess that's where we're going to watch to see if that continues to hold. We can look at a chart in a bit on it. But I think there's some support around 67 on oil. We're at 68. We bounced off of the 67 already today, and we're holding up here on 68. Does it mean it won't go lower? No, it's in a downtrend. It could absolutely continue to drop lower. We'll see what happens with oil, but I think we're getting close to an inflection point on oil that it's either going to find the base here, or it's going to break that base, or again, it could really shoot higher. It's getting narrower and narrower here on oil. So we'll see what happens on oil. Let's move on to ES. In ES, we have a bunch of 112s and a bunch of strangles. We have the 4 weekly strangles. 3 of them are in this futures expiration cycle, the U3s, and then on the Z3s, we do have 1 other strangle that we just put on a couple days ago on Wednesday. If you were following along in the trades today in Discord, I did close out that 5th one that I did not close a week and a half ago. I wanted to hold because I thought we were a little bit overbought. So I wanted to hold that one on. So we closed that thing out for a profit today. So we took in 30% winner on that trade. It took us an extra 7 or 8 days to get it, but now we're back to having our 4 strangles, and then we have a handful of 112s in here. You'll notice this first 112 and this second 112, both of these 112s are missing the naked puts because we've closed those for 95% winners. So we've already closed the naked puts that go with these. We're just sitting on these put debit spreads. So we have some free hedges on. For the next 112 here for July 31st, we're at 94.8. I do close these at 95%. Yes, I could probably close it today, but you know what? I'm going to wait 0.2% more. If the market, bounces a bit, we hit 95, I will close this one out as well. All right, so that one's working on the trade. And then we've got some other ones working in here. Another 112 down here, 88% on the naked puts, nothing to do with that one. There's another one down here, 83% on the naked puts. Totally fine, making good money on these. Nothing to do on those yet. And then the last 112, another one down here, 80% on the naked puts, and doing just fine on this trade. We're up a good $1,500 or so on those. And then we have the strangles working. All strangles are in positive territory. If you would look at ES on the Analyze tab, here's what we're looking at on this thing. So here's where we're sitting up in here. If everything stays the way it is, we'll pull in about 11 grand on that trade. If we happen to fall down here, you can see this monstrosity down in here around 3,500 to 3,900, a pretty good sized tent, in the $30,000 to $40,000 range. So if we drop, we're in pretty good shape on this particular trade. So that's what this expiration of ES looks like, the U3 expiration on that. And then for the next expirations out, we've got the September ones, and then we've got an October one, 112 as well. All of those are in positive territory, along with the most recent strangle that we have that's already up pretty nicely. All right, so nothing to do in ES. We're full. We're out to October 20th, 120 days right now. I'm not putting anything on until the next expiration gets to 120 days. If I was looking at that expiration on ES, that's going to be, oops, I really didn't want to actually open it. That's going to be this October 31st. So we've been usually doing around the 15th and 30th. This time it was the 20th and 31st. But I've got 10 days to go until this hits 120. Then I will add another long-term 112 trade here. All right, so that's ES, nothing to do, just hanging in there and doing our thing on ES. Gold, what do we got working on gold? We have a couple things. So one, we have a 112 trade that is in the trap right now for a 209% winner. So taking a look at that particular trade, let's take a look and see what that looks like. Make sure. Analyze tab's a little funky. A little hard to see, but here we are in the trap, squarely in the trap. Full trap profit, $920. On this one, we weren't super wide, but instead of 420, we're looking at $920 if we stay in this trap. And again, as of today, we're at, roughly $900 up. This 112 in gold cost us almost $7,600. So we were going to make 420 on 7,600, which would have given us roughly a 6% return. And this was a 50 DTE trade when we put it on. So 5.5% return in 50 days. So it's over a 1.1% a week on that trade, which is perfect. Puts us right where we want to be on this particular trade. But we were looking at a nice 5% return. But now we're actually looking at an 11% or so return on this particular trade. So we're sitting in the trap. I am not closing it. The only thing that's going to make me close this is if we really start to move up here. Now, we don't have a lot of time left in this trade. There's only 4 days left. It'll expire next Tuesday. So we'll be making it through today. We've only got Monday and Tuesday to worry about. If for some reason it rallies 40 points, I'll look to potentially close to keep as much of the trap as I can. But right now, there's nothing to do. I'm not going to close it early because I still have a little bit more money to squeeze out of it. We're at 880. My maximum's 920. I can take another $40 out to just wait. I don't need the BP for anything yet. So I'm okay. If I do want the BP, I can free up probably $7,000 in BP today. If something happens or there's something good to get into, I'll look to do that. If not, I'll just let this thing come off on Tuesday. All right, so there's a 112 on gold. Let's take a look at the other gold positions. These are all strangles. I have increased my size to 2 contracts from 1, but all of these are in really, really good shape right now. The 1761 here for 810, we put that on for 870. The 1775 is at 750. We put that on for 9. The 1800 is at 495. We put that on at 820. So that's almost a 40% winner right now. And then this $18 or 1810 2325, we put that on for $9.50. It's at 470. It is at a 51% winner right now. So we won't be closing anything till next Wednesday. But if we do, most likely it will be this 1810 strangle, which is also the oldest strangle that we're sitting on, I believe, at 23 days. All right, so there's your gold strangles. Nothing to do on those. Now, again, the question came up, what about putting on, we just did this in CL, let's take a look in gold. If I'm putting on a 112 in gold, I'm using about $7,700 to make 420. Okay, so I'm making 420 using 7,700 in margin, 5.5% return. Now we're in the trap, so obviously the return is going to double because we're in the trap. That's the benefit of the 112. However, these strangles on gold that we do weekly, we use around 5,500 in margin on these, but if we close them at 50%, we're taking in again about 400 and no, actually a little bit more than that. So if we're closing them at 50%, now that I'm using 2, I'm taking in roughly $880 on 5,500. So again, strangles a lot less expensive than a 112. So I'm in a strangle, I'll make 880 on 5,500. In a typical 112 that's not in the trap, I will make 420 on 7,700. Okay. So I'm making quite a bit more on the strangles than I am the 112s. It doesn't mean you can't put all 112s on, but you are going to chew up your buying power quicker. I can't get that trade to work or that strategy to work in this larger account, simply because I will run out of buying power and not be able to make the same return I'm making now. But you could change it again to the 112. We'll talk more about that. All right, let's look at lean hogs. The lean hog trade we got on, we put this on 11 days ago. We're up 9% on this particular trade. All good, nothing to do, nothing to worry about on this particular trade. Here's what that 112 looks like. Oops, tough to get these things to center right. So this is what that looks like. Right now, if we stay in the tail, we'll make $1,000. If it drops into the trap, we'll make almost $6,000 on the lean hog trade. Now, this was a $5,358 margin product. I have 6 contracts on. So it's a 6-contract 112 costing me, I mean, the lean hogs is an unbelievably great leverage product. So this trade, I should make hopefully $1,000 on a $5,000 return in 60 days. Okay, that's going to give me almost a 20% return in 60 days, 10% a month. Pretty nice trade with a lot of safety here. So I really like the lean hog trade here, but that's again me using 5,300 to make 1,000. If I wanted to do something similar with a strangle, there is no 90-day strangle, but let's go out to the 112s and just take a look kind of at our standard setup of 7 delta, 6 delta on the lean hog. And let's go up to, you know, again, I'm going to take a $2,000 credit because I'm going to close it at 50%. So I'm going to spend $3,000 to make 1,000. Remember, on the 112, I spent 5,000 to make 1,000. Again, on the strangle, 3,000 to make 1,000 there. So again, the strangles give you much better leverage, much better return because you're selling, you know, 2 different options that are sharing the same buying power essentially. So in a 112, I'm not. I'm only on the put side, and I'm paying a little bit for a debit spread. I don't have the call side on for free, which would give me more credit. So again, strangle's more efficient. Now, oh, you're worried about getting into the trap, or you're or on the 112, or you're worried about your strangles getting tested, but you still want to make $500 on, or $1,000 on 5,000, which is the same as the 112. So all I would need to do on that is, or be safer, I'm sorry, as I get here, I can drop down to maybe like the 3 delta and go up here and bring this to about a 3 delta. You want to be a little safer. You want to get a little farther away. On hogs, you can still pull in $1,000 using almost 5,000 in buying power and get yourself way out. So we got 48 for the far end of this particular strangle. And if you remember in the 112, we were at 60. So I can get 12 points farther on hogs. Okay, because of the leverage you have, you can do super wide strangles. If you want to go even further down than 3 delta, you can do that. If you want to find something closer to 5, you can do that as well. Get yourself a pretty good credit. Okay, to make about $1,000 on this one, cost me about 3,800. So again, strangles, much better use of buying power, much better use of capital than a 112, but you do have risks potentially of one side getting tested on that. All right, so that's hogs. Let's look at NASDAQ on the NQ futures. We have 2 112 trades running right now. We're up combined. We're up about 79% on these. If we take a look in NQ, I got to scroll 9,000 times to get this thing to appear. I don't know why it's this ticker symbol's the worst on Tasty. All right, so you can see way down here, I can't even get the whole thing into the picture, and you can't even see where we are. right now. So there's where we are, sitting up here around 15,100. We're not close to the trap. However, you know, we're in good position here. We've got security all the way down to 1,200. This particular trade is going to give us $895 winner. And that $895 winner is going to come on the heels of an $11,000 buying power trade. So I make $895 on $11,000. So it's going to give me, again, 8% return. And this was a 49 DTE trade. Okay. So you get a chance to see what it would be trading 112s on Nasdaq. So you see, I do have a lot of 112s on futures. They're just not as buying power efficient, but I am generating income on a lot of these 112s. So I do have a lot of 112s running. That's one on Nasdaq, and then there's another one sitting here about this, and it's not the same. So this one is not correct. 11,250. Let's see, where are we? Okay, the difference in this one is this was a BA 112. So this is not a standard 112. This is the big ass 112 that I'm taking in very little credit. So it's costing me very little in credit, or I'm getting very little income on this trade. The margin to put this one on was only 4,700. And I've got this giant, wide, big ass traps that you got to scroll 90 times to get through, all the way down to 11,000. Okay, so the Nasdaq is going to have to drop 4,000 points, okay, in the next 38 days. So we need to drop 4,000 points in the next 38 days, which is essentially a 26% drop to even have me worry about it. However, to get into this trap, okay, I only need to get down to about 14,050, something like that. So that's 1,000 points down from here. Well, 1,000 points may seem like a lot. You got Nasdaq down 100 points today alone. So in 10 days, on a moderate drop like today, in 10 days, we could technically be there. But that's not a huge drop from here. It's a 6% drop in Nasdaq in the next 38 plus days. And I don't have to actually get in there. I just got to be close to that mark. So we're up a little in this particular trade. I think if I'm eyeballing this one, we're up, $100 or something right now. But this is a BA 112 on the NQs. VC, taking a look at corn. Everybody's got problems in corn these days. Why? Is there a problem in corn? Well, look at that rally that we've had in corn. So when we take a look at corn on the daily chart here, let's actually get to it's a 3-month chart. I think that's still good enough. So here's this is what corn's been doing, and it's really been pushing quite a bit higher here. So if you've been in corn, you've seen a pretty solid up move right to its downtrend line. Can't really see it on this particular chart because I'm only going out 3 months. But why is corn rallying? If you're paying any attention to the futures you're trading, you would know why corn is rallying. If you live in Iowa or Illinois, the Corn Belt, you also know why corn is rallying, because you have a drought and you have no rain. So there's no rain in northern Illinois. There's no rain in Iowa. There's not a whole lot of rain expected, maybe an inch of spotty rain here and there. Corn rallying like crazy. Now today you got a pretty good pullback. This thing came up, hit a little bit of resistance. So we might start to see corn dropping, but I don't like to play Strangles during planting season. I like the off season a little bit better for corn. Corn traded in a pretty good range from, let's call it August of last year until really April of this year. So that's the best time for me to want to trade corn, is really from somewhere in July till, maybe end of December, March, something like that. I just try to avoid planting season. Last June, for the month of, let's see, on the weekly, if I can switch over, I'll share it. Well, here's corn. Look what happened last May and June on corn. It dropped significantly. I mean, that was a massive drop from here all the way down to here in July. I don't care what's going on during planting season. Okay, that's where you're experiencing a lot more volatility from that April till July standpoint. April was its high, big drop into July. This year, April high, way down, way up. Who knows what's going to happen next? Let's keep an eye on. We got this uptrend line still intact on corn. We hit this downtrend line here. We'll see what happens, but that's why I stayed out of it. Okay. And I was only playing the 1-1-2 game on corn. So that 1-1-2 on corn is doing pretty well. If we take a look at the Analyze tab on this one, okay, we're sitting up here with about a $238 potential profit here. So 238 on a 2,862 margin. So almost 10%. I think it was an 8% return on this trade for 60 days. I put it on too light. I should have used about twice the buying power. I should have used twice the number of contracts. I should have aimed for a lot more of a return, but you know what? I'll take the return of 8%. I just would like to have more than $200. But if corn does start to retrace, okay, now we got some, some interesting activity. We're already up 90% now, but if that corn retraces, okay, down here towards the 460 level or so, which would be below its, May lows. So I don't see it happening, but who knows what's going to happen to corn. If the corn crop is busted, we could rally because prices are going to rise. If the corn crop gets some rain and we get some good storms in Iowa, Northern Illinois, and China wants some more corn or somebody, then fantastic. Just don't like planting season, too many variables. The weather, I cannot control. So just keep an eye on what you're doing in corn. But if you stick with the 1-1-2, yeah, great downside on this thing. The lowest corn has been, okay, and that's the lowest since October of 2021. We're talking 500 is the low, okay? Our trap is way below 500, so that's a pretty good trade. Why not? And corn, just like hogs and so forth that we were looking at earlier, is a pretty good leveraged product. So you can get 10% on this trade. And if you want to make equivalent to a strangle, you probably can get pretty close and be a lot safer. All right, so there's corn. That's enough on corn. Soybeans, I actually have two 1-1-2 trades going on soybeans. Now, soybeans taking a pretty nice little hit today. Let's see where we are. So soybeans are moving down a bit towards my trap, okay? If I'm doing strangles, I've had a massive run lately. Why has there been a massive run lately? Again, do some due diligence on it, but soybeans, Brazil is producing soybeans by the boatload, and they're sending them all to China, and China is now full. They're not taking a whole lot more soybeans. So there's, a ton of pricing pressure, out there on the U.S. Crop as well. So it's been running up pretty substantially. We'll see what happens now that China may be slowing down. That's going to put maybe a little bit of a continued damper on demand. And when demand is down and supply is up, we might see some pricing dropping. But until then, we've been seeing pretty good upward price. But anyway, so on soybeans, Here's our 112. We're getting closer to the trend. We just don't need to get there tomorrow. But the low here is 1100. And if you look at soybeans, the low from 2021 in October was 1181, was around here. So this would be the lowest point soybeans have been in 2 years from a pricing standpoint. So if we get there, beautiful. We're going to make a lot more money on this trade. And again, soybeans, we're getting almost a 10% return on both of these trades that we have on here. So they're doing very well on these. So we'll keep it rolling. So this one's right now at a small $100 profit or so, and this one I think is at a slight loss, mainly because of this 110 put. We've only been in this trade for 7 days, so it's all good. You got a pretty good drop in the market in the last 2 days of trading. So, all right, so there's soybeans. That's why we're doing what we are in there. Amazon, we've got the synthetic long position. This thing is now up, what, $9,000 and some and change. So we're already up over $9,000 in 86 days on the synthetic long here. And then we've got a covered call. It's going to be close today, but we got a covered call here that's going to expire today as long as we stay under 131, which we keep flirting with the middle 130 today on Amazon. And ES is off of its lows on the day, so we'll see. If Amazon starts to creep up more, we'll be okay. But if not, we're still up $311 on the day. We do have a call credit spread that is not doing as well. We'll keep an eye on that. Was expecting Amazon to take a little bit of a break. It's not doing that. Amazon had a monstrous day yesterday. So yesterday it jumped up from, I think it opened about its low on the day was like 125 and it closed at 130 yesterday. So a $5 update on Amazon. So Amazon picking up some steam here, which is perfect for our synthetic. We just trade around it. So nothing to do on Amazon. IWM is a leap put. It's kind of just floundered around. It's not doing anything. It's down $2. So nothing to do on IWM. We'll just let that thing go for a while. SPX, we're sitting on 2 put butterfly trades. These are hedges. They're down a couple $100. It's a hedge. If the market drops, maybe those will pay. If not, who cares? SPY, we've got 3 of our leap puts. SPY are our leap puts here. We have 3 of them. One's already at 23%, so we're getting close to our 30% on this. Yeah, Kathy, with Amazon and AI, could keep running. I think all this stuff is running on AI, and who knows why. I think AI is still, it's the buy the rumor, sell the news type of thing. And right now the rumor is that AI is just going to keep, making millions of dollars. I don't think AI is making a whole lot of money for anybody yet. They haven't really monetized it, but hey, just on those rumors alone, Amazon's up, rocking and rolling, and we'll see what happens. So it's the hot thing right now. It's the in thing, the it thing, but so was the metaverse, if you remember. And boy, the metaverse was going to be Roblox and Adobe, and Microsoft was going to rule the metaverse. So there's all of those metaverse plays that you had that really have fizzled out. I don't even know what Roblox is looking like anymore. It hasn't moved since April of last year. It's at the exact same price that it was on April 18th of last year. So much for the metaverse craze. So maybe the AI craze will be different. I don't know. I don't see giant monetization yet. It's cool. There's great things. I wrote an entire presentation using it. I had it script my PowerPoint, script my presentations. I've got it do on one of my other businesses. I've got an AI text bot that will text with all of my customers without me hiring any humans. It responds and sets appointments for me. So fantastic, but haven't really monetized it yet, I don't think, in a big way. All right, so there's SPY. We're doing fine on these. The latest one's only 3 days old. I don't really care. Then take a look at VIX. We've got a call spread, the last one alive, fixed at a whopping $12.93. That thing is just dead. And then lastly here, XLE, we've got a leap put on energy here. This one's 10 days into the trade. It's down 12%. We'll just let energy go for a bit. Nothing to see or do there. So there's the portfolio. What I want to do for just a moment or two is jump into my my spreadsheet and give you guys a little sense of what we already talked about it, but let's talk about it a tad more. Let's look at what's the difference again in doing 112s and strangles. If I'm doing strangles on futures here, again, I'm averaging, if I average 50% on these trades, I've got 4 strangles on futures running. I'm using $15,000 in buying power to make around $2,400. Okay, so $2,400, again, 50% is where I would close a strangle. So $2,400 on $15,000 of strangles on futures. That's not counting the weekly gold and ES strangles that I have on. I'm just talking standard strangles on futures. That's a 16%. And if you look at the 100% returns, just cutting those in half, that's almost a 16% return on your margin. If you're putting on 112s on futures, and again, I do have these on, so I am trading those, okay? But the margin here on 4 of those, 26,000, 20,000, so, you're 20, 22,000 to make 1,400. So back here, strangles on futures, I'm making maybe 2,500 on 15,000. On 112s, I'm making something like 2,500 or less on $22,000. So I'm not even making 2,200 on these. I'm making somewhere in the neighborhood of, 2,000 maybe. Let's just call it $2,000 on a month on 22,000 in BP. They're fine. That's not a bad return. I mean, you're getting, look, 5, 7, 8, 10, 12, 19, 18%. So I can get a decent return on margin with these, but I'm not getting the same 15, 16% return I get on strangles. I'm getting probably half of that on 112s, using twice as much, or maybe not twice as much, but maybe 30% more buying power. So the question in our Discord group was, can we just go to 112s on everything, because strangles just too much, too much work, too nervous when stocks move one way or the other, don't want to take any losses on it. The tough thing about hitting this is I would be very hard pressed to hit my goal. Okay, when I look at the trading, I don't know if I'm sharing the right thing, so I don't know what you guys are seeing. Let's reshare. I'm just going to reshare the screen. So if you can see my screen. So here, when I look at the trading plan, I've got to come up with at least $8,000 a month. Okay. Can I do that on all 112s? Well, it's going to be difficult to do on all 112s when on average, okay, here I'm spending $22,000 divided by 8. So let's take 22,000 divided by 8 positions. So let's say my average position, oh no, I'm sorry, I'm at 46,000. $46,000 divided by 8 positions. So my average buying power is 5,700 to make on average, let's say $600. Okay, so $600, and I'm using 57.50 in buying power. Okay, for me, I need to generate $8,400, right? So if I'm getting $600 per trade on a 112 in futures, spending about 5,700 in buying power, okay, and I got to make my 8,400. Okay, so 8,400 divided by 600 means I will need 14 of these to expire every month. And I'm out 60 days on these. Oops, I'm out about 60 days on average on these 112s on futures. Okay, 14 of these has to expire. Now, those 14 would be 57.50 in buying power, which is 80,000. But don't forget, if I'm going to have 14 expire every month, I will have to have 28 trades working, because half at 60 days, half will expire. I got to put 14 new trades on every month. So that means I'm going to need actually $160,000 in buying power to power my account using 112s on futures. It's all good, except my buying power maximum is only around 140,000 if I keep a 50% buying power. All right, so I would only be able to trade this strategy only, and I almost don't have enough buying power to put all of these on. So is it really feasible to run an entire portfolio on 112s? I don't think so. I think you've got to have these strangles on futures mixed in, because these are really your money makers. Do you lose some money on them? Yeah, periodically you do. If I look at my weekly strangles, as I look through these, this month I've closed, I've closed 3 tranches of them, of 2 each, gold ES, gold ES, gold ES. So I'm closing them every week. I've made $3,000 this week alone on this trade. And to get there, I've used 17,000 in buying power only to make $3,000. Okay. If I look at last month in May, I made 5,800 on these strangles. The reason being was because this was a 5-week month instead of 4, but the month before was only a 3-week deal in April because we didn't have enough on, but we still made $4,000 that month. So we've been very consistently knocking out $4,000 a month on weekly strangles using 30 grand, maybe. I think this this month is going to be very normal. So using probably 20-some thousand dollars. When I look at my plan, I was planning on using 25,000 to make 4,400. Doggone it, if that's not like the amount of money that we're averaging right now. So we're hitting our plan. I couldn't do this in 112s. Okay, 112s on futures. This is what I've done since March when I started tracking it. I'm starting to pick up a few more here, but only a couple trades, 2 early trades on nat gas, and then a couple oil and gold ones so far in May. None have come off in June. Okay, but I do have, let's see, I have 1 coming off in June, but then July, I'm going to have at least 3 112s. I'm going to try to get it consistently where I have 4 coming off a month on these. That's my goal right now. I just couldn't survive on only 112s on futures. I have to have those strangles running because the buying power and the ROI is so much greater, generating so much more income on less buying power. All right, hopefully that makes sense to everybody here, gives you a sense of what that looks like. And I think we'll probably wrap it up here. But that's where we're sitting on most of these trades. The weekly strangles are doing great. Like I said, we're up $3,000. We've got a whole nother week next week. Hopefully we'll have some nice profits. Our strangles on futures, we're having a good month, 2,500 on those for the month. The long-term 112s that I've been doing, I'm just starting to hit having 2 a month coming in. So I'll start bringing closer to $4 grand in cash on those. The 112s on futures, those are starting to pay a little bit more. The leap puts. So it's really just having those 3 to, I shouldn't say 3, those 4 different strategies on there, but mainly it's 112s and Strangles on futures. So I think if that's your portfolio, I think you can do really well just having 112s on futures and Strangles on futures, but I think you got to mix them up, maybe a half and half, something along those lines, so that you can spread out that risk a bit, and you just got to get the most out of your buying power. And 112s just aren't. They're not bad. No one's going to go complaining that they're getting 8 to 10% a month return, or 8 to 10% in 60 days, which is 4% a month. No one's going to complain about 4% a month on it. At least you shouldn't. All right. If that does it for me today. This is a long presentation, so I'm glad you guys all hung around in there with me today. Hope this makes sense. We'll post this video up in the Discord for you guys to follow later. All right. Enjoy a fantastic rest of your afternoon. Have a great weekend, everybody. Take care.